Hello everybody and welcome back. In this video I want to talk about Napco. They just reported the earnings and I just did some work so you can really understand what is happening with this quality company. In this video I want to talk about the report, right? I want to analyze it and you will have my comments. I also want to share my own work that I just made like a few minutes ago. It's a Google Sheet and I did some analysis to really understand really well what is happening with Napco, because I just finished to listen to the call, so I added some comments from the call so you really understand the situation. In case you don't know Napco, this is a quality company that is shifting from a hardware company to a software company with nice margins, a lot of cash flow generation, a lot of dividends, a lot of buybacks, and the valuation was reasonable. Okay, I'm saying was because we are going to talk about this one. So this is what you will get in this video. Earnings report, my own comments on the report, my own Google Sheet, and some comments from the call. So you will know everything about the latest earnings report for Napco. Also, as I'm recording this video, this is the day of the earnings, one day after this. So the stock is down 8%. And for some reasons, in pre-market, because of the report, the stock was up 5%. And then market opened, immediately tanked minus 13%. After this, it rebounded. My strong guess is algorithms are driving this. People are not really reading the report. People are not really doing the work. So in this video, I want to do the work. So you really understand the situation, to see if the growth rate is good or not, to see if you have some adjustments to make. So yeah, I think we can start. In case this is your first video from this channel, welcome. My name is Christophe Noor. I'm French. I've been investing in the stock market for almost a decade now and I have achieved a performance of 25% per year. And full disclosure, I was a shareholder of Napco in the past and I sold it, okay, because of lack of conviction, and I saw other opportunities. But I'm still monitoring the situation. I did not lose a lot of money on this one. I think I bought here and I sold here, so a minor loss. And during this time, I bought Lam Research, which doubled. So it was a good arbitrage for the short term. Time will tell if this is good for the long term. But yeah, I was a shareholder. I'm no longer a shareholder, but I'm still monitoring the situation. And yeah, I want to take my time for this video to really show you my process, how I analyze quarterly reports. Okay, so in case you don't know Napco, let me read the description. Napco manufactures security products encompassing access control systems, door locking products, intrusion and fire alarm systems, and video surveillance products. Its products are used for various applications, which includes alarm systems like automatic communicators, combination control panels, digital communicators, and digital keypad systems, fire alarm control panel, and area detectors, mainly used for commercial, residential, institutional, industrial, and governmental. Okay, so most of the profits, most of the revenues are from the US, and they do everything that is linked to security. So special locks, special security control systems, special monitoring of schools. For example, in case you have an intruder, you can have the hardware, okay, so the alarms, the doors, special doors, all this monitoring of this data, but also the software. And also they've been introducing a software segment since 2017 to have a recurring revenue. In case there is an intruder in the school, you call directly the cops. Okay, so same thing for firemen. And this change in business model from a hardware business model to a recurring high margin software business model, you can see it right away. Look at the revenue growth. Everything accelerated here. Look at the net income growth. Everything accelerated. Now the business is largely profitable. Look at the free cash flow growth. Nothing, and boom, everything picks up. Look at the balance sheet. No major cash, and then boom, massive cash generation. Same thing for the return on invested capital. It was like roughly 10%. Look at the ROIC here, return on invested capital, ROIC, 10%, 15%, and then it goes up 22, 25, 30, 50% ROIC. Okay, so everything accelerated for this business model since they introduced the recurring high margin system, and over time this high margin segment, the recurring segment, took more importance in revenue. In the past, back in the days, it was 10% of the revenue, so it would not move the needle. But because it is growing so much, because the software part is growing so much, it has become 20% of the 20% of the revenue, 30% of the revenue, 40% of the revenue. And now I just did the split. We are at 47% of the revenue coming from service. Half. You now understand why the margins for this business are going up. You now understand why the ROIC, the return on capital for this business, is going up. You now understand why the growth rate picked up largely. This is a small cap. The market cap is $1 billion. So if you go to Fiscal AI, you go to financials, you will not find a section called KPIs. The business is so small that Fiscal AI is not integrating all the different segments. So the hardware part, the software part, the different margins, you have to do manually the breakdown. Don't worry, I did it for you. You will have access to the data during this video. Okay, so by the way, if you want to use Fiscal AI, I have a discount code in my description. I believe now with the Black Friday period, it's even cheaper right now, like this week. So use my link in the description. It will get like 15-25% cheaper if you want to use Fiscal AI. It's one of the best websites you can have. I'm using this on a daily basis. Okay, so let me show proof of what I say when it comes to margins improvement. These are your gross margins, gross profit margins over time. You see that in the past, the gross margins were at 30%, and then everything improved 40%, 50%, and now we are 55%. So why don't we look at the report now so I can add some comments, and then we'll talk about the numbers so you can really understand, because maybe you are watching this video and you are a shareholder, or maybe you're watching this video and you want to be a shareholder. Anyway, this will get pretty interesting. Okay, can I download it or I stay here? That's fine. Napco reports is the Q1 2026 result for this one. Strangely enough, it ends in September, but the fiscal year is delayed. So for them, it's their Q1 2026. The revenue is up 12%. You will understand why after this. The equipment revenue increased by 12%. So this is pretty interesting. The recurring service revenue increased by 11%. What I told you in the past, meaning the software segment is growing massively, well, you have a slowdown now. This business is no longer growing at 40% per year. It is growing only by 11% per year. This is fine. And this recurring segment is growing with a 90% gross margin. RSR, recurring service revenue, had a prospective annual run rate of approximately $95 million. Last year, it was $94 million. So it seems like this software part is decelerating. Gross profit margins were 56% compared to 55% last year. Diluted EPS increased from 30 cents to 34 cents. This is an increase of 12.7%, so 13%. Okay. Let me continue. This is what you can see from the income statement. Revenue going up 12%, gross profits 13%, improvement in margins. The net income is going up by 8%. Now, if you have studied many businesses, you can feel that there is something strange here. Okay? The revenue is going up by 12%. The margins are improving, so gross profits are going up. Okay? But the net income is only going up by 8-9%. Something is fishy. Something is a mess here. And don't worry, in this video, I will tell you what happens. So, the net income margins decreased. You have a decrease in net income margins from 25% to 24%. What is happening here? This business was expected to be more efficient with better margins over time with the software segment that is ruling over the world, and now margins are going down. Is this the top for this business? This is a good question. At the same time, earnings per share are going up by 13%. The difference here are the buybacks. And the cash flows from operating activities are flat. The second point, is this the top? This line should be a yellow flag for anyone reading this report. Why are net margins going down? This thing should be a yellow flag also. Why is the software part only growing by 11% per year and not more? And also, this should be a yellow flag. Why is the operating cash flow line not going up? Why is it not up 10%, 11%? 3 yellow flags. And we just started the analysis. Okay? Okay. So let's see what the CEO has to say. Richard Soloway, chairman and CEO, commented, with the completion of the first quarter of 2026, fiscal year 2026, we experienced year-over-year double-digit growth in both our equipment and service revenue. Strong demand for our door locking products has driven the growth in our equipment revenue and improved equipment gross margins. We will see that later. And our RSR continues to see growth quarter over quarter with a sustained gross margins of over 90%. It now represents half of the revenue in Q1, and you have a prospective run rate of $95 million. As a result of our revenue growth, net income increased 9% year on year. This is bad, but okay, we'll see why. And the adjusted EBITDA margin was 30% compared to 28% last year. We remain focused on expanding the recurring solutions across all our platforms, including wireless fire and intrusion alarms. This is what you say. If you have a problem, you have a line directly to the fireman or to the cops. Into enterprise access control systems and architectural locking products, including our MVP access platform, which is gaining traction in the marketplace. Yes, they were talking about this during the earnings call, but I would not elaborate on this. I need more color to have a clear opinion, so I will not focus on this paragraph. The results are a positive start to the new year, the new fiscal year for them, and we remain confident that our net income, adjusted EBITDA, and cash flow will continue to be grow throughout the balance of the year. Do you really have a mistake in the earnings report? I'm not very fluent in English. This is not my mother tongue. So maybe you have a mistake, or maybe this is proper grammar. If you are from the US or from the UK, please let me know if this is right or not. We will continue to be growing. Okay. Anyway, this is funny. This is also the reason I sold this company, because I was not sure about certain qualitative things. Anyway, as such, as we are pleased with our dividend program, we will continue the dividend program, blah, blah, blah. And we see no buybacks. Okay. The management team for this company is known to be not great. Okay. The management team has been selling their own shares for years now. So you had insider selling for many years. In the past, the CEO and chairman owned a large part of the company, and he progressively sold all his shares because he's now 75 years old. So yeah, normally it's normal, but it's still a yellow flag. I mean, you sell the majority of your holdings, this is quite bad. About the balance sheet, what do you have? Nothing really exciting. I want to go straight into the income statement. The cash is not changing. They have accumulated more cash. Yeah, the format is not great actually. The format is bugging for their report. It has always been the case. Nothing here. They sold some of their stocks they had in the balance sheet. Nothing here. They reduced the amount of property, plant, equipment. Okay, interesting. So they sold some assets. That's the reverse of capex. At the same time, they decreased their inventory here, long-term inventory, and nothing really here. Dividend is here. Let me just double check really quick so you don't miss any information. Accounts receivables, salaries, no, nothing really here. Okay. And what about the cash flow statement? What? Why is it bugging? It's a good question. Deferred income taxes. Oh, it's about tax. Okay. Yeah, the reason why the cash flows are not growing. I'm starting with the balance sheet and the cash flow statement because I want to spend more time on the income statement, right? Okay, so let me just skim a little bit through the other financial statements so we can spend much more time in the income statement, okay? For the cash flow statement, I want to understand why the cash flow from operations are down year on year. By the way, if you want to become a better investor and improve your performance, I have a coaching program. It gives you the exact method I've used to generate 25% per year for almost a decade. More on that at the end of the video. If you go to Fiscal AI here and you check the cash flow statement, you go to financials, cash flow statement, you can see on a quarter-over-quarter basis all these columns. September 2024 at September 2025. You see the cash flow from operating activities went from 12 to 11.6. So what changed? Well, you can compare on a year-on-year basis what is happening. Net income is going up. The DNA is going up. The SBC is going down. Well, this is a good sign of efficiency, by the way, but it's only 0.06. This line, other adjustments, is going up. This line, change in trade receivables, is going down. So maybe this is our culprit here. Change in inventory, almost nothing. Going down, but that's minimal. Changes in accrued expenses went up 2%. And change in other operating activities went from flat to minus $2 million. So the two culprits to really understand the reason why the operating cash flows are going down, these are these two lines: change in trade receivables and change in other operating activities. Is this a red flag or not? Well, depending on your analysis. You have a line 0.56. This one. Account receivables went from positive. In the past, it was like 3 million euros. It was a positive last year, and now it has become negative. It's an impact of $4 million. Strangely enough, this document is being cut because of the format. This is not my fault, it's the way they report. It's just quite bad. And only this line had an impact of $4 million. If you only adjust for this small line, the operating cash flows would have increased by $4 million more. Okay? And the second point is changes in other operating activities that went from minus 0.27 to minus 2.29. So $2 additional million that needs to be adjusted maybe. What is the reason of this big decline? Well, you have this income tax receivables plus maybe this prepaid expenses. You can do the work at home of how can you get 2.29. This is not the goal of this video, but just to have a rough idea of what is moving. What is moving is short term. You can see here over the past years how these two lines were volatile. Let me call it this way. And here we go. You can see that this is a mess. You can't really understand what is happening for the blue line, changes in trade receivables, and the red line, changes in other operating activities. It is volatile, changing every time. So it's not because of the business model is getting poorer and the business model is getting bad. No, it's just part of the daily operations of this business model, right? Working capital, you win some, you lose some. It's part of how you manage your cash flows. So the reason why the operating cash flows are down, minus 3%, are not red flags. This is what I have to say. Okay. And after this, if you look at the capex, almost no capex. They sold some of their stocks in their portfolio. They didn't do any buybacks and they continued to pay dividends. Okay, what is really not good, I would say, what is really bad, what I don't like to see, is the lack of buybacks. But the stock has gone up so much. Okay, let me show you what I mean. You have the forward P. Anyway, okay. In this big chart, I will explain what is happening, don't worry. In red, here, you have the operating cash flows. Okay, so the cash generated by the operating activities. In blue here, you have the buybacks. You can see that they started the small buyback program in 2015, in 2018, and in 2020. And a big buyback program, their biggest buyback program, in 2024. In 2024, they bought back $7 million worth of shares. And then the next quarter, $10 million worth of shares. And then $18 million worth of shares. The blue line was so big, it was more than the red line. So they used more than 100% of the operating cash flows to do these big buybacks. And in orange here, you have the forward PE ratio. The forward PE ratio. What you want to check here is, are they doing smart buybacks when the stock is cheap? Well, they did a buyback program when the PE ratio dropped from 50 to 30. They started a buyback program, and then the valuation continued to drop to a forward PE ratio of 25. So they did more buybacks, and then the valuation dropped to a forward PE ratio of 20 at the bottom of 17, and they did their biggest buyback ever. And now, as the stock is rebounding, the valuation is rebounding, they are stopping the buybacks. This is a smart way to allocate capital, but I would like to see more of this and less dividends, actually. Now, Napco has a great problem of having too much cash. They don't know what to do with their cash. So they just started a dividend program. Here, dividend. They just started a dividend program, and they are very happy with the dividend program so far. So look at this. In the past, you didn't have any blue lines. In 2023, the company has had so much cash, they didn't know what to do with the cash. They don't need capex, they don't plan to do an acquisition, so they just issued a dividend. And now what is the yield on Napco? You have a dividend yield of 1%. Absolutely zero debt to repay. You are filled with cash, and now you are doing dividends. Yep. Okay, so capital allocation wise, it's okay. Now, let's talk about the big financial statement, the income statement. If you look at this income statement from the report, you have a few lines, but you want more. What is the growth rate of each line? Well, I did it. Here is what you have. Here is what you have. Let me put my face here. Let me zoom in so you see better. Okay, so normally you should see better. It's zoomed in enough. I just created this. So for this quarter, this is the column C, and the quarter of last year, the column D, and in E, that's the growth rate. You have two business segments, as I told you before in this video. The equipment revenue that went up by 12%, and the service revenue that went up by 11%. What do they have to say about this one? First, now it's 50-50. 50% of the revenue comes from hardware, 50% comes from software. And they said this during this earnings call. This is a quote from this earnings call. Matt, so in response to that, of the approximate 12% increase in equipment revenue for the period, so they are talking about the hardware part, our primarily analysis has indicated approximately 60% of that growth is related to volume increases, which is good, and 40% of the growth is tied to the pricing increases that went into effect in Q1. You probably know that they work with the Dominican Republic, and you have a tariff rate of 10% for this country. So you need to account for tariff, and immediately when Trump announced tariffs, global tariffs, they increased their prices. So They did 2 price increases in 2025, one during the tariffs and one later. So 40% of this growth, well, you have a growth rate of what? 12%? So 4% of this growth is due to, roughly 4% of this growth is due to more prices, and 8% of this growth is due to volume, or something like that. You get my point. It's 40% price, 60% volume. For the split in service, they don't provide any information. They will tell you additional color, but they don't provide this split, which is unfortunate. Anyway, because the two segments are growing at 11 or 12%, and because they account for half of the revenue, the total revenues for this company are growing 12%, which is good, fairly good. I mean, a few quarters ago, we had worries that the equipment revenue would not grow because of a postponing of demand from clients. Okay? I don't know if you're familiar with the Napco story, but a few quarters ago, at the beginning of 2025, they had a decline in equipment revenue because 2 or 3 big clients postponed the buying of equipment, saying, no, maybe with the tariff uncertainty, we will buy from you, Napco, but maybe later, maybe next year. So for the moment, we are just canceling our demand, our sales. Okay, so now seems like growth is back a little bit, double digit, 12%. What about the cost of equipment revenue? So Fiscal AI is not giving you the KPIs. I'm giving you the KPIs. About both segments. The first segment, hardware, the cost of equipment revenue. This is the cost of equipment. Sorry, my brain just froze. The COGS for the revenue. The COGS for the hardware part, 8%, 9%. So this segment is growing by 12% per year, but the costs are growing by 8-9% per year. This is pure operational leverage, and the margins for this segment are going up from 23% gross margins to 26%. A large improvement, by the way. A couple of quarters ago, people had worries about this segment. Now it seems like the growth is back and the margins are back. Margins are improving because you have more prices, okay? Better prices. About the software now. The software part is growing by 11%, but the costs are growing by 21%. So they are investing more investments, and accordingly, the margins went down from 91% gross margins to 90% gross margins. To be honest with you, I don't care. To be honest with you, look at this line. That's $2 million of costs. You compare this with the cost for hardware of $20 million. So we don't care much. We don't care much about what is happening here. Yes, exactly. You are talking about a small amount. So yes, it can be scary to see this line growing 20% more cost, but come on, this is peanuts. And they have a comment in the earnings call about this increase in investments. Okay, that's a big copy paste that I just did. So the margins, the margin profile, it did go down from a little bit over 91%. 2 factors. Factor number 1, we now have a triple carrier radio that introduces T-Mobile into the mix. We have to buy minutes to support that. We have not really charged anybody for that, and even though it is not a lot of money, of costs, it did move the needle a little bit. Margins went from 91% to 90%, okay? The expectation is we will increase our recurring radio charge to cover that. So it's only a matter of time until margins go back up, okay? Because they will increase the prices, okay? More volumes, more prices. It is not going to be a lot, but it might be enough to move the needle back to where it was. That is one factor. Another factor is we are gaining a lot of business from some very large dealers. And then you have another quote, so I copy-pasted from a few minutes later in the earnings call. And so this is another quote. Believe me, we don't want to mess with a very good formula. I like the shareholders. I want to keep that 91% margin as well. if we have to raise it a little bit to keep it up there, we are going to do that. We are looking at that now, Peter. Second quote for this. Second quote about the big players. The one negative of this is having like, so the management team is telling you margins went down because now we have to invest, and we will price that later. And second point is now we are dealing with bigger clients, and because we have bigger clients, they can negotiate the rates. So we have to lower our margins a little bit to sell volumes. The one negative of this, and it is mostly positive, is a big guy can command a little bit of a better price. Maybe the big guy pays $1 less than what the smaller guy is paying. We honor that. We are happy to get more business. If a guy was paying $8 and we have to lower it to $7, just to use an example, we will do that. We will do that all day long because we are picking up more radio recurring revenue business that could move the needle a little bit. Absent of that, it is all the same powerful margins that you have been seeing in the past. So now you understand why they are having more cost than the revenue and why the margins are going down. They are investing a little bit more and they are getting bigger clients. A good question to ask is, you have margin pressure to get more clients, so are you struggling a little bit? Because if you are getting margin pressure, maybe there is a problem here. And it's not as if this segment was growing immensely. The service revenue is only up 11%. So are you struggling to sell? So you are lowering your margins? Because if you had not lowered your margins, the service revenue would have grown high single digits? Good question to ask. That's maybe a yellow flag, okay? This is maybe important. We will see next year. So, if you account for the revenue growth rate of 12% and the total cost of revenue going up 10%, the gross profits are going up by 13%. You have operational leverage. Your revenue is going up more than your cost. So the gross margins are going up from 55.9% to 66.6%. That's peanuts, right? You go from 56 to 56, 56 to 56.5, we don't care much. But still, an improvement overall in gross margins, a little bit of efficiency. Next point, down the income statement, that's the R&D, the R&D cost. Okay, this line is going up by 6%. So they don't invest massively in R&D. You have something that works, and they don't want to change it, actually. The other line is the SG&A. 13% growth rate is SG&A. Maybe they are hiring massively. Maybe they are increasing the salaries. Something you want to see, you want to monitor. So, in the remarks from this call, you have comments. Why is the R&D segment growing 6%? They say the increase for the 3 months primarily resulted from increased labor costs, so better salaries, which was partially offset by reduced consulting fees. Okay. And for the SG&A cost, they said the increase is SG&A for the 3 months was primarily due to increased legal fees and sales commissions, partially offset by decreased bonuses and compensation and benefits. We have seen before that the SBC was going down. At the same time, you have legal fees and sales commissions. Fair enough. I don't see this as a yellow flag at all. I don't see this as a risk at all. This is just part of the business. So, the total operating expenses are up by 11%. Pretty good, right? Your gross profit is going up by 13%. Your operating expenses are up by 11%, which means you have even more operating leverage. So the operating income, the core operations of the business, are growing by 15%. I said strong core operations. You see, the revenue is up by 11-12%, but the EBIT, the operating income, is up by 15%. Pretty good. I mean, this report was pretty solid, which means the operating margins for this segment, for this business, went from 27% to almost 28%. Again, a tiny bit of more efficiency for this business. What about the next line? The interest income. This line is decreasing 9% because you generate less cash from your balance sheet. As I told you previously, Napco has no debt and they are filled with cash. Look at this. This is your cash balance. You are filled with cash. What do you do with your cash? Either you pay a dividend, either you do buybacks, or you generate a yield because you invest in bonds, for example. You have a balance sheet, you have your cash balance, and you generate a yield, a 3 or 4% yield on your cash. Well, they said this. The decrease for the 3 months was due to lower interest income from the company's cash and short-term investments as a result of lower interest rates. Interest rates are going down, the Fed is cutting interest rate, so you generate less cash from your balance sheet, okay? Less interest from your balance sheet. And this line, we don't care, it's only, that's peanuts. So, if you account for everything here, the income before taxes is going up by 12%, okay? Because you reduce this accordingly. Now, here is the big part that I've seen no one talk about on Twitter or on YouTube. The provision for income taxes. So, the tax. The tax is up by 36%. The tax rate went from 14% tax rate to 17% tax rate. 3 points of difference. And this is the reason why the net income growth is so bad. Okay? And the tax rate increased meaningfully. I can show you what I mean here because I did a screenshot so you can understand the situation. This is a screenshot I took from Fiscal AI, the effective tax rate of the company. You can see that it is always fluctuating. And now, what can I say? Since 2022, the tax rate was 13%, 13%, 13%, 40%, 15%, and now we are the highest tax rate in the past 3 years. Almost 17% tax rate. So this is why the net income is not growing so much. And I have something to say about this. Why is the tax rate going up? The increase in the tax rate was due to higher pre-tax income, as well as a larger portion of the company's taxable income being attributable to US operations. The measurement of certain deferred tax liability is due to tax rate changes enacted by the One Big Beautiful Bill Act in the current period. Maybe this is something you can cross-read with Meta platforms that had a massive tax rate increase for the latest quarter. And Meta platforms had to pay a large amount of tax for this quarter, the same quarter a couple of days ago. Maybe this is the same thing happening with Napco, right? This is a one-off event with higher taxes, and for the future quarters, the tax rate will be lower. So it is not a yellow flag at all to see this. It's only temporary. It's a one-off event. And this is the main reason why the net income is only growing by 8.76%. If the tax rate had been the same, and this is also why I am doing my own work, is I can play around with some numbers. If the tax rate, if the taxes were not 2.47, but I don't know, 2. Okay. If 2.1, if the 2.05. Okay. If the tax rate was 14%, the net income would have been $12.5 million. And that would have resulted in a net income growth of 12.5%. So you have a big difference between this 8% growth, oh come on, and 12% growth. Yep. Okay, after this, you have to account for the buybacks. As I told you before, they stopped buybacks 2 quarters ago, but still, like 2 quarters before this, they did some massive buybacks. As I told you, $18 million, more than 100% of the operating cash flows, which means on an annual basis, the number of shares declined by 3%. So the earnings per share goes up by 12-13%. Again, if the tax rate had not changed, the net income would have gone up by 12%, and because of the buybacks, the earnings per share would have gone up by 16-17%. This is why I say this earnings report from Napco is not bad. It's actually solid. It's just you have a couple of adjustments, including the tax rate, which lowers the performance. So when they announced an earnings per share growth rate of 12-13%, you are not getting excited, and I get it. But this is only a one-time change for taxes. If you adjust for this, the earnings per share is going up almost 17% per year, which is bullish. And if you listen to the earnings call, the management team is pretty confident to start their fiscal year in a very good shape. Now about the valuation, if you go to Fiscal AI, you go to ratio, forward valuation, you put your, anyway, it would not matter much. Price to free cash flow, price earnings, you are talking about the same numbers here. The forward PE ratio for this company is 30. A couple of months ago, it was 22. Is it fairly valued for such a company? Well, you have two scenarios. Either this company continues to grow at 10% per year, 12% per year, and this is a little bit expensive, or they reaccelerate like they had a couple of quarters ago. If the revenues accelerate, if the margins are trending up, if the tax rate stays low again, this is fairly valued, and Napco is a good buy right now. So really looking forward to seeing the other reports from this company, the future quarters. But yeah, this was the kind of analysis you do if you want to make 25% per year. As always, if you want my help to do the same for your stocks, if you have any questions, you know where to find me. You have the first link in the description. And that's it for today, guys. I see you tomorrow. Bye-bye. If you like this content and you want to go deeper, I have a coaching program. In this program, you will learn the strategy I use to outperform the market. You will learn how to find winning opportunities. You will learn how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio with great companies. Additionally, inside the program, you will have access to an exclusive community of like-minded investors, and you will also have access to my personalized guidance to reach your investing goals. Click the first link in the description to get more information. You will get a short video that explains how everything works, completely for free. No need for your email address, just click the first link in the description and I'll see you on the other side.